At 8:16 a.m., the yen was sold, and Tokyo didn't know why. It wasn't a crash, not yet. But on the terminals of a few trading desks in Marunouchi, the price slipped, just a tick, then another. Quiet, controlled, calculated. Billions of yen exchanged for dollars, then euros, then pounds. But the source wasn't Japan. The orders came from London, from New York, from offshore banks with no logos, just codes. The Bank of Japan noticed, but didn't intervene. The move was too small, too technical. Another blip in the storm of global flows. Except this wasn't a blip. It was extraction. Because somewhere in Manhattan a fund manager had made a decision, not to invest in Japan but to borrow from it, not because of its economy, but because of its interest rates. 2% in Tokyo, 9% in Chicago, borrow low, lend high, repeat, scale. The carry trade wasn't new. But now it had found its perfect host. Japan, rich, disciplined, and liquid, became the world's cheapest lender. Not by law, by design, by mistake. This was no attack, no takeover, no invasion. It was something quieter. Wall Street didn't break Japan. It plugged into it. A pipeline disguised as a partnership. A trade dressed up as global finance. And before Tokyo understood the shape of the game, it had already become the bank. The day Japan became the lender of last resort. To everyone but itself. Debt was rising. But interest had a direction. By the early 1980s, the United States was addicted to spending and allergic to saving. Reaganomics unleashed a wave of tax cuts, military buildup, and deficit expansion. The U.S. government needed buyers for its bonds, and fast. Domestic savings weren't enough. Foreign capital became essential. Interest rates in America soared above 10%. Investors loved the yield. Borrowers paid the price. The dollar surged, pulling in global capital like a magnet. But the consequences would be felt far from Washington. Meanwhile, across the Pacific, Japan told a different story. It had spent the 1970s exporting its way to dominance. Cars, electronics, machine tools, all stamped made in Japan, all in high demand. Trade surpluses mounted. Domestic savings rates approached 20%. The Bank of Japan, cautious and conservative, kept interest rates low to sustain exports and suppress inflation. The result was a paradox. The most productive nation on earth, flush with cash, earning almost nothing on it. And someone in New York noticed. Wall Street didn't need permission to borrow. It only needed access. And Japan, with its loose capital controls and endless liquidity, had become the quiet engine of cheap credit. The setup was too perfect. Borrow in yen at 2%, convert to dollars. Buy U.S. Treasuries at 9%. Pocket the difference. No factories required, no products built. Just spread, leverage, and time. The carry trade was born, not as a theory, but as a necessity. The U.S. needed capital. Japan had too much. The trade wrote itself. And while Tokyo focused on export figures, trade balances, and currency diplomacy, a more powerful flow began beneath the surface. Capital was leaving Japan. Not to flee, but to serve. To fuel Western consumption. To fund Wall Street's expansion. To underwrite a world in which the borrower dictated terms to the lender. And someone at Goldman was watching. Tokyo thought it was untouchable. By the mid-1980s, Japan was the envy of the developed world. Its cars outsold Detroit. Its electronics outpaced Silicon Valley. Its trade surpluses dwarfed anything seen before. The Nikkei soared. The yen stayed weak, and the West watched in awe and fear. To the Japanese, this was the natural result of discipline, planning, and perfection. To outsiders, it was a fortress, precise, impenetrable, relentless. But every fortress has a gate. Japan's gate was credit. The Bank of Japan kept interest rates low to protect its exporters. A weak yen meant Toyota could outprice General Motors. Sony could flood the world with Walkmans. From Sapporo to Osaka, factories hummed. The Ministry of Finance declared victory, and for a moment it was real. But behind the scenes, liquidity was piling up. Domestic consumption remained flat. Real wages stagnated. Capital had nowhere to go. It began to seep out, quietly, systematically, through cracks in policy and ambition. Foreign banks took notice. So did hedge funds, asset managers, and investment banks. They saw what Japan couldn't, that its strength was also its vulnerability. With yen borrowing costs near zero and the dollar yielding 7 to 10%, the logic was irresistible. Wall Street began to borrow in yen, lend in dollars, and scale the spread. The flows were massive, but disguised. No bombs, just bonds. Japanese banks, flush with deposits, became silent partners. They extended credit domestically, which was then funneled offshore. Multinational corporations set up Cayman subsidiaries. Investment arms recycled yen through global carry trade channels. And no one in Tokyo sounded the alarm. Why would they? The yen remained weak. The markets were strong. Foreign reserves were growing. On paper, everything was working. But beneath the shine, a quiet extraction had begun. Japan's monetary system was no longer serving Japan. It was underwriting global speculation. The carry trade didn't attack Japan. It used it. The world's second-largest economy had become Wall Street's funding desk. "We are the engine of growth," said one Tokyo minister. They were. But the engine was being siphoned, one low-interest loan at a time. He wasn't famous. He didn't want to be. But in 1986, tucked inside an office high above Park Avenue, he discovered the trade that would turn Japan into the world's silent lender. It didn't come from ideology. It came from numbers. He wasn't interested in GDP charts or speeches from Tokyo. He was watching interest rates. He saw that borrowing yen cost less than inflation. He saw that U.S. treasuries were yielding 3, 4, 5 times more. And he saw that no one was connecting the dots. He didn't care about culture. He cared about capital. And the capital was sitting idle, mountains of yen deposited in Japanese banks, earning next to nothing. So he borrowed it, legally, quietly, through swap lines, shadow accounts, offshore affiliates. Then he converted it to dollars, bought high-yield bonds, reinvested profits, and levered up. He wasn't alone for long. At first, his risk managers said it was reckless. Currency exposure, political uncertainty. But the model worked. Every test proved it. Every trade confirmed the thesis. Japan had locked itself into a low-rate regime to support exporters. The Bank of Japan would not raise rates, could not. To do so would punish Sony, Toyota, and the very pride of the Japanese economy. So he leaned in. What began as a $20 million position became $100 million, then $1 billion. By the end of 1987, his desk was generating more profit than entire divisions. Not by building, by borrowing. Not by producing, by repositioning capital from one world to another. He didn't call it extraction. He called it optimization. He wasn't trying to hurt Japan. He thought he was helping. Japan had too much savings. The U.S. had too much need. The market simply needed someone to build the bridge. He built it. He designed structures that borrowed yen at 2% and reinvested the proceeds into dollar-denominated debt at 9%. The spread was glorious. The risk seemed manageable. The scale? Unlimited. Soon other banks followed. Merrill Lynch, Morgan Stanley, Deutsche. The yen became the cheapest money on earth, and Wall Street drank from the faucet. Japanese banks, eager to lend and under pressure to show growth, became willing partners. They extended credit to anyone with a suit and a plan. And the man who started it all watched as the system he birthed grew beyond him. He stayed quiet. That was his way. No headlines, no press, just spreadsheets. Every time Japan announced low inflation, he smiled. Every time the U.S. issued more debt, he saw opportunity. And every time someone warned that the carry trade was risky, he shook his head. Risky to whom? To him, Japan wasn't a competitor. It was a funding base, a silent engine that powered the global expansion without ever asking for control. It was the bank, and he was the borrower. He didn't need to break Japan. He didn't want to. He just needed the yen, and Japan kept providing it. By the end of the decade, the trade was global. Hedge funds were using yen to finance real estate in London, infrastructure in Brazil, equities in New York. Japan's domestic credit market, once provincial, now served Wall Street's wildest ambitions. He had proved the world didn't need a central reserve bank. It only needed an interest rate differential. He didn't plan to trap Japan, only to finance America. But intention didn't matter. The effect was the same. Japan had become the global lender of first resort, not through conquest, through capital, and he was the architect of that quiet empire. He never needed permission, only access. The yen was available, and that was enough. Through Tokyo branch offices, Cayman shell companies, and Luxembourg conduits, Wall Street began to build a pipeline. One end pulled from Japanese savings, the other poured into the risk assets of the Western world. It was called the carry trade. But it was more than that. It was an unspoken transfer of power. Capital didn't just leave Japan. It was extracted, disguised as liquidity, masked as globalization. But at its core, it was leverage, exported and multiplied. Japanese pension funds, insurance giants, and megabanks were sitting on trillions. And with interest rates near zero, they were desperate for returns. That desperation became the crack in the wall. Foreign investment banks exploited it. They issued structured products wrapped in U.S. bonds, mortgage-backed securities, and synthetic spreads. Promised stable yield, 5%, 7%, even 10%. To a Japanese bank earning 2%, it was irresistible. The process was simple. Borrow yen, convert to dollars, invest abroad. Yen was weak, dollar was strong. Profits multiplied on both ends. And every time the Bank of Japan pledged to hold rates low, the pipeline widened. By 1986, billions in Japanese liquidity were flowing into U.S. Treasury auctions. Japanese demand for American debt became so aggressive that entire issuance cycles were effectively pre-sold. Japan wasn't just financing America's deficit soon, it was financing its illusion of growth. But the money didn't stop at government bonds. Wall Street realized they could use the yen to fund anything. Corporate bonds, junk debt, Latin American projects, even real estate, especially real estate. Japanese-funded entities began buying office towers in New York, apartment blocks in San Francisco, golf courses in Arizona. On paper, it looked like investment. In reality, it was arbitrage, and Tokyo barely noticed. Capital outflows were framed as diversification, a healthy step in a maturing economy. Officials praised Japanese global presence. Newspapers celebrated overseas acquisitions. But no one asked the deeper question: what happens when a nation lends more abroad than it invests at home? The answer came slowly. Domestically, Japan began to hollow. Bank loans were increasingly disconnected from productive activity. SMEs struggled to access credit while megabanks funded offshore ventures. Liquidity flooded into the stock market and real estate, not because of domestic confidence, but because capital had nowhere else to go. The Nikkei rose. Land prices doubled, then tripled. A square meter in Tokyo's Ginza district cost more than a Manhattan block, and still the yen flowed out. It was leverage disguised as liquidity, a trade disguised as growth. A shift so subtle even the Bank of Japan treated it as benign. But the system was rigged. The moment Japan tried to raise rates, the carry would unwind. Investors would flee, the yen would spike, exports would suffer, the stock market would tremble. Policymakers knew this. So they didn't touch the rate, couldn't touch it. They were trapped by their own liquidity. Wall Street, meanwhile, expanded. Asset bubbles inflated from borrowed yen. Corporate takeovers funded by Japanese cash. Junk bonds supported by invisible flows from Tokyo. No one needed to understand the source. The returns were enough. But some noticed. In internal memos, the Ministry of Finance began to raise quiet concerns. Structural imbalance, one document said. Unsustainable spread dependency, said another. But by then, it was too late. By 1987, the yen was the unofficial backbone of global speculation. Traders knew it. Hedge funds worshipped it. Every boom, every rally, every bubble had one thing in common. Japan was footing the bill, and no one had voted for it. This wasn't partnership. It wasn't alliance. It was flow-based dependence. Tokyo didn't control global finance. It subsidized it. And every dollar lent abroad was a yen that didn't build Japan. The nation had become the bank, and the borrower never even thanked them. In September 1985, 5 nations met in secret at the Plaza Hotel in New York. The room was quiet. The decision was not. The United States, Japan, West Germany, France, and the United Kingdom agreed. The U.S. dollar was too strong, dangerously strong, and it had to fall. The plan was straightforward: coordinated intervention, a statement of unity. Central banks would work together to sell dollars, buy yen and Deutsche Marks, and push the greenback down. The goal? Restore trade balance, strengthen export economies outside the U.S. cool American deficits without raising interest rates. But beneath that goal was a deeper motive: control the tide that Wall Street's dollar dominance had unleashed. For the U.S., a weaker dollar meant relief. For Japan, it meant disaster, because the Plaza Accord worked too well. Within 2 years, the dollar fell over 50% against the yen. What cost 250 yen in 1985 now cost just 120. Exports from Japan became more expensive. Trade surpluses shrank. Companies panicked. Profit margins evaporated. And the Bank of Japan was cornered. To prevent a recession, it cut rates even further. From already low levels, it sank deeper, pushing overnight rates toward 2.5%, then 2%. Cheap capital became even cheaper, and the carry trade caught fire. Now Wall Street didn't just borrow yen. It borrowed faster, larger, and with more certainty. Because Japan had just confirmed what every trader suspected. It would sacrifice its monetary sovereignty to protect exports. Money poured into Japan's domestic system but never stayed. It passed through, a conduit to global leverage. Meanwhile, inside Japan, the consequences brewed quietly. Low interest rates pushed domestic banks into overdrive. Lending became blind. Real estate developers borrowed endlessly. Stocks soared, not because of earnings, but because of liquidity. From 1986 to 1989, the Nikkei doubled. Land values in Tokyo tripled. Office towers were worth more than entire U.S. cities. People said the Imperial Palace was worth more than California. And still the Bank of Japan refused to raise rates. Why? Because the yen was already strong. Too strong. Exports were already hurting. Any rate hike would draw more capital in, strengthen the yen further, and threaten what remained of Japan's competitive edge. So the money stayed cheap, and the bubbles swelled. The Plaza Accord was meant to restore balance. Instead, it broke the seal. Japan, trying to avoid external pain, triggered an internal one. It chose liquidity over correction, survival over discipline. And Wall Street? It barely blinked. U.S. markets continued rising. Borrowers kept borrowing. Japan's capital underwrote leveraged buyouts, real estate speculation, emerging market bets. The yen became a silent partner in every Western boom. It wasn't just a currency anymore. It was a commodity, extracted, recycled, multiplied. In 1987, the U.S. asked for more help. Another meeting. Another round of interventions. The Louvre Accord was signed to stabilize currencies, but the damage was done. Japan was addicted to low rates, and the system now depended on that addiction. Some Japanese officials knew what was coming. One MOF economist warned, "We are fueling a fire we do not understand." But no one stopped it. The world had rebalanced the dollar by unbalancing Japan. What was meant to be cooperation had become capture. The carry trade was no longer a strategy, it was a structure. built on Japan's silence, supported by its savings, expanded by its refusal to say no. The Plaza Accord did not weaken the dollar, it weakened Japan. By the final days of 1989, Japan stood atop the world. The Nikkei reached 38,957. Property in central Tokyo was worth more than all the land in Canada. Office towers sold for double their construction cost before the first floor was finished. Every salaryman with a brokerage account became a paper millionaire. Bankers whispered about Japan buying California. Politicians spoke of a century of dominance. Economists coined a term, Japan Inc. But beneath the skyscrapers and speculation, the soil was already cracking. The entire economy was bloated on credit. Cheap yen had inflated everything. Banks lent against land that had no true price. Collateral was valued by imagination. Interest rates were negligible. Risk had vanished. Until the Bank of Japan blinked. In May 1989, after years of watching the fire grow, the central bank moved. It raised the official discount rate, modestly at first, then again, and again. The intent was soft landing, a slow deflation of the balloon. But markets don't respond to theory. They respond to fear. By early 1990, the Nikkei collapsed 30% in weeks. Real estate transactions froze. Developers defaulted. Banks realized their collateral was vapor. Panic spread quietly, not with riots, but with silence. Loans went unpaid. Projects were abandoned mid-foundation. And still, no one used the word crisis. But it was. As asset prices fell, the yen carry trade began to unwind. Investors repaid loans by selling assets, triggering more declines. Foreign capital exited. Domestic firms liquidated holdings. Japanese banks, once the lenders to the world, were now stuck with bad loans and vanishing cash flow. And the government hesitated. Policymakers feared that admitting the problem would worsen it, so they delayed, covered, extended credit to failing institutions, allowed zombie banks and corporations to remain on life support. Japan entered a unique state, not collapse, not recovery. Paralysis. This was the beginning of the lost decade. From 1991 to 2001, Japan grew slower than any developed economy. Its stock market never returned to its peak. Property prices declined year after year. Household wealth evaporated. The miracle became a cautionary tale, and all the while the carry trade turned toxic. What once funded global growth now became a chain reaction of repatriation. As foreign borrowers closed yen-funded positions, they had to buy back the yen, strengthening it. A rising yen further strangled Japan's exporters. The same flow that once lifted the world now pulled Japan into deflation. Interest rates were slashed. By 1995, the BOJ cut to near zero. It didn't work. Liquidity traps formed. Consumers stopped spending. Businesses stopped borrowing. Investment dried up. The tools of monetary policy failed. Debt ballooned. Fiscal stimulus was unleashed. Highways to nowhere. Bridges with no traffic. GDP barely moved. A country that had once lent to the world now struggled to revive itself. The carry trade didn't end. It mutated. Global speculators began using Japan's zero rates to fund new risks. Dot-com stocks, emerging markets, even Russian debt. But Japan no longer benefited. Its credit was globalized. Its economy was not. Inside the country, despair set in. An entire generation entered the workforce with falling wages, no job security, and declining dreams. Politicians changed. Prime ministers fell. But the structure remained. No war, no famine, no collapse. Just drift. Quiet, polite, irreversible drift. Tokyo, once the brightest skyline in the east, became a symbol of how an empire can fade. Not with violence, but with yield curves. The Bank of Japan tried everything. Zero rates, quantitative easing, public works, asset purchases. Nothing reversed the trend. Japan had been the world's lender, and now it couldn't even lend to itself. The nation that once held the world's capital now struggled to believe in its own future, because the bubble wasn't just financial, it was psychological. And when it burst, so did the idea that growth could be engineered. That liquidity was a substitute for value, that money could rise forever without consequence. The empire had become a colony, a credit colony. Its wealth exported, its savings drained, its future discounted. The carry trade worked, until it didn't. And when the math reversed, Japan had no defense. The world didn't stop for Japan. Wall Street barely flinched. By the mid-1990s, U.S. markets were roaring again. The tech boom had begun. Silicon Valley attracted capital by the billions. Dot-com companies with no profits saw their valuations skyrocket. American investors forgot Japan's fall, or pretended it never mattered. After all, the money had moved. The yen had served its purpose. But in Tokyo, time stood still. Office towers remained half empty. Land that once cost 10 million yen per square meter was now worth 1. Banks held portfolios of debt that would never be repaid but couldn't be written down. The government kept injecting liquidity. Rates hovered near zero. Year after year, officials spoke of recovery. Year after year, it never came. They called it structural, cultural, deflationary psychology. But no one said the quiet part aloud. Japan had been drained, not looted, not conquered, just quietly, efficiently drained. The profits earned from yen-funded trades never returned. They stayed in New York condos, London bonuses, Caribbean accounts. The capital that left Japan never looked back. And why would it? There was nothing left to take. Wall Street had moved on. To new bubbles, new frontiers. Brazil, Russia, tech IPOs, subprime mortgages. But Japan couldn't move. It was stuck in the shadow of its own generosity. Because that's what the carry trade was, a gift. One Japan never meant to give, a subsidy to the world's riskiest bets, a silent transfer of wealth from savers to speculators, from east to west, from prudence to leverage. And now, with its monetary ammunition spent and its confidence shattered, Japan became something it had never been, dependent, on exports, on hope, on luck. The country that once financed the world now struggled to finance itself. And yet no one was held accountable. The architects of the trade were celebrated, invited to conferences, quoted in books. Some retired at 40, some started hedge funds, some faded into quiet wealth. But the system they built remained. Zero interest rates became normal. Central banks across the world studied Japan, not to avoid its fate, but to replicate its tools. When crisis came to the West in 2008, the solution wasn't new, it was Japanese. Cut rates, flood liquidity, keep credit alive no matter the cost. The irony? Japan taught the world how to fall, and how to survive the fall by never admitting it happened. Inside Tokyo, the skyline still sparkled. Bullet trains still ran on time. But behind the beauty was stagnation. Behind the order, decay. Whole blocks of real estate remained unsold. Generations lived with their parents. Growth became a memory. This wasn't a collapse. It was a slow disappearance. And while Wall Street celebrated the next bull market, Japan remained frozen. The ghost of a superpower that lent too much, asked too little, and stayed polite until it vanished. The yen carry trade was never buried. It was cloned. By the early 2000s, what began in Tokyo had become a blueprint for global finance. The logic was seductive: borrow cheap, lend dear. The model worked in theory and in the real world until it didn't. But no one remembered the crash. They remembered the yield. Traders copied it with the US dollar, then the euro, then Swiss francs. Emerging markets became the new playgrounds. Brazil, Turkey, Hungary, all offered double-digit returns funded by near-zero money. Liquidity was abundant, risk mispriced, and memory conveniently short. Central banks joined the game. The Federal Reserve cut rates in response to crises and never truly raised them back. The European Central Bank followed. Quantitative easing became doctrine. Negative interest rates became policy. Every economy wanted growth. No one wanted pain. But pain didn't disappear. It migrated. Leverage surged. Global debt tripled between 2000 and 2020. Real estate boomed from Vancouver to Shanghai. Equities soared in New York and Mumbai. It looked like prosperity. It felt like progress. But beneath the surface, the same flaw remained. Borrowed growth, backed by borrowed money. And Japan watched in silence. It had seen the movie. It had lived the ending. It knew how it feels when the music stops and rates can't rise. When central banks become the market. When savers are punished. When demographics shift. When innovation stalls. When a nation becomes a yield play for the world. And then a warning no one wants to hear. By 2020, Japan still held over $1 trillion in U.S. Treasury securities. Its investors still reached abroad for returns they couldn't find at home. It was still a creditor nation, still the silent bank behind the global casino. The world had learned Japan's tools, but not its lesson. Because the carry trade isn't just a financial strategy, it's a structure of dependency. It turns savers into servants. It rewards volatility and punishes stability. It extracts value without investing in it. And it moves on before the damage settles. Japan was the first to host this system, but not the last. After 2008, the U.S. became the lender. After 2015, Europe. Then China. Then crypto. Each time a new source of liquidity. Each time a new frontier of extraction. No one calls it imperialism, but it is. Quiet, efficient, bloodless imperialism. Enforced by spreadsheets instead of soldiers. No flags. Just flows. And as capital moves faster than governments, faster than regulators, faster than nations, the line between sovereignty and solvency blurs. Japan was once the second largest economy on Earth. It had the capital, the discipline, the industry. But it lost control of its own credit. It became the financier of bubbles it never built, the sponsor of risks it never saw. Empires don't fall in explosions, they flatten into balance sheets, and sometimes they keep standing, but only as monuments to what they once were. Japan didn't lose a war. It lost a yield curve. There were no treaties, no invading armies, no surrenders signed under spotlights, just 0.5%, then 0.25, then 0. One decision at a time, one policy at a time, until the nation that had once financed the world could no longer finance itself. This wasn't destruction, it was dilution. Japan wasn't conquered. It was borrowed into submission. The yen, once a symbol of post-war resurrection, became a funding vehicle. Tokyo, once a beacon of productivity, became a cautionary tale. The most disciplined economy on Earth became a silent underwriter of global leverage. And in return, it got nothing. No gratitude, no security, no growth, only drift. And what makes it worse is that the world learned nothing. The carry trade wasn't dismantled. It was replicated. The playbook lived on, just in new hands. Other central banks stepped into the role. Other currencies took the baton. The architecture of risk was never torn down. It was reinforced, because cheap credit is seductive, and the profits are instant. But the cost? The cost arrives slowly, invisibly. And by the time it does, it's already too late to unwind. Japan didn't fall. It faded, beneath debt, beneath deflation, beneath decisions made by others with its money. This was financial warfare without missiles. A campaign waged not with force, but with flows. And the damage wasn't explosive. It was quiet, permanent. Empires built on savings were dismantled by borrowing. And the lenders never saw it coming. Subscribe to Shadow Empires, where money became warfare.